It's 1957. Inside a small laboratory at Columbia University, a pigeon is standing in a box. In front of it, 2 buttons. Press the left button, and food appears 70% of the time. Press the right button, and food appears 30% of the time. The pigeon figures it out within minutes. It presses the left button. Every single time. It doesn't try to decode a pattern. It doesn't switch buttons to test a theory. It doesn't second-guess itself at all. It just presses the one that works and collects its reward 70% of the time. Now, the same experiment was given to humans, educated adults, people who understood probability, people who, by every measure, should have done better. They didn't press the left button every time. They tried to figure out the pattern. They switched. They theorized. They second-guessed. Their average success rate, 62%. The pigeon outperformed them by 8 percentage points, and if that sounds small, in investing, 8 percentage points is the difference between retiring comfortably and running out of money. Let's start with the assumption that feels obviously true. More intelligence means better financial decisions. More analysis means better outcomes. The more you study markets, the more actively you manage your money, the better you do. This is the foundational belief of the entire active investment industry. It employs millions of people. It manages trillions of dollars. And the data has been quietly, consistently, devastatingly contradicting it for 60 years. The pigeon experiment wasn't a curiosity. It was the first clean demonstration of something psychologists now call probability matching. And it is one of the most expensive cognitive habits the human brain possesses. Here's what it is when humans encounter a system with a dominant pattern, a button that works 70% of the time, a stock that's gone up more than down, a fund manager with 3 good years. They don't simply exploit the pattern. They try to predict the exceptions. The brain, faced with any sequence of outcomes, immediately begins searching for hidden structure. It cannot accept randomness. It cannot sit with the discomfort of a system it doesn't fully understand. So it constructs a narrative. It finds patterns that aren't there, and it acts on them. The pigeon doesn't do this. The pigeon has no narrative constructing machinery. It sees, left button works more. It presses left button, endlessly, patiently, and it wins. In 1973, economist Burton Malkiel at Princeton published a book called A Random Walk Down Wall Street. Its central claim was simple and savage. A blindfolded chimpanzee, throwing darts at a newspaper's financial pages, could select a portfolio that would do just as well as one carefully selected by experts. The financial industry called it absurd. 40 years of data proved him right. Standard & Poor's publishes a report every year called the SPIVA scorecard. It measures how many actively managed funds, run by trained professionals, using sophisticated analysis, charging significant fees, outperform a simple index fund over 10 years. The number, consistently, across decades, across markets, across countries, is around 10%. 9 out of 10 professional investors, doing exactly what the human brain is wired to do, are beaten by the equivalent of pressing the same button every time. But here's where it stops being about pigeons and starts being about you. Psychologist B.F. Skinner, the same researcher who first studied pigeons in those Columbia boxes, made a discovery in the 1950s that became one of the most replicated findings in all of behavioral science. He called it the variable ratio reinforcement schedule. It works like this. When rewards are unpredictable, when pressing the button sometimes gives you food, sometimes doesn't, with no discernible pattern, the brain doesn't disengage. It becomes obsessed. The dopamine system, which governs motivation and reward seeking, fires most intensely not when rewards are guaranteed, but when they are intermittent, unpredictable. Skinner found that animals on variable ratio schedules would press levers compulsively, far more than animals receiving consistent rewards. They would press to exhaustion. They would press through punishment. They would press long after the rewards had stopped entirely. Now, think about what the stock market is. Prices that move unpredictably, rewards that arrive intermittently, a system that occasionally, randomly, produces extraordinary returns. It is, structurally, a Skinner box. And your dopamine system cannot tell the difference between a lever in a laboratory and a trading app on your phone. In 2011, researchers at the California Institute of Technology put investors inside fMRI machines and watched their brains during simulated trading sessions. What they found should be required reading for anyone who has ever checked their portfolio more than once a day. The moment a stock price moved unexpectedly, up or down, it didn't matter. The brain's reward circuitry activated, not when money was made, when something unpredictable happened. The brain wasn't responding to profit, it was responding to the possibility of pattern, to the chance that if it just analyzed hard enough, watched closely enough, traded quickly enough, it could decode the system. The subjects who showed the strongest neural responses were also the most likely to overtrade, to buy high and sell low, to confuse activity with progress, to feel, in the words of one researcher, like they were doing something, while systematically destroying their returns. Here's what the financial industry understands about this, and what it has built around it. Every feature of modern trading platforms, the real-time price feeds, the push notifications, the charts updating by the second, the red and green colors, the one-tap trading, is optimized for the variable ratio reinforcement schedule, for keeping the dopamine loop running, for making the Skinner box as frictionless and as stimulating as possible, because an investor who checks their portfolio once a year and never touches it generates almost no revenue for the industry, but an investor who watches and reacts and trades and watches again generates fees, spreads, commissions. An industry that profits from your activity has no financial incentive to tell you that your activity is the problem. Now, here's the part that should sit with you. Knowing all of this doesn't fix it. In study after study, when participants were told about probability matching before the experiment, shown the data, explained the pigeon finding, told explicitly that the optimal strategy was to pick one option and never deviate, they still matched. Not as severely, but still. Because the drive to find pattern, to construct narrative, to feel like you understand what's happening, that isn't a belief you can update. It's a feature of the architecture. It runs below conscious awareness. It was there before language, before logic, before any financial concept you've ever learned. So the next time your phone lights up with a price alert and you feel that pull, that specific, familiar pull to check, to act, to understand what it means, that's not a financial instinct. That's a pigeon in a box. That's 400 million years of pattern-seeking architecture doing exactly what it was built to do. You didn't choose it. You inherited it. And the most expensive thing you will ever do with your money isn't a bad investment. It's the moment you forget that the box is still running, even now, even here, even as you decide, tonight, whether to open your portfolio one more time. Money is never really about money. It's about the brain behind the decisions. If that idea interests you, subscribe. We're just getting started.